Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Benzinga Pro. I'm your co-host, Joel L. Conan, along with Spencer Israel, and we have Peter Schiff on the line of Europe Pacific Capital. He is the chief global strategist, and he's going to give us some ideas about his strategy. Peter, how you doing on Friday the 13th?
I'm doing all right. I'm doing okay. I don't think it looks looking like it's going to be bad luck for the markets though today. So
yeah, it's sure tailing off going into it. Well, I mean, I'm probably about as sick of hearing about interest rates going up as you are. It's the talk. We get a hot jobs number in November. The Fed's thinking about putting a kibosh here, taking interest rates up. I mean, is this economy really growing? And not only our economy, but the global economies. Is there this much strength where we can withstand an uptick in interest rates?
well, the economy isn't strong at all, number one. I mean, last month's job report was only hot in relation to what the expectations were. Yes, it was a little bit better than expectations at 271,000 jobs. But last year, the average job creation per month was higher than 250,000. So, based on last year, it's only slightly above average. And the last two jobs reports, back to back, were the weakest two jobs reports of the year. So all we did is create some jobs in October that we didn't create in August and September. So it really wasn't a strong report. And in fact, if you look at a lot of the retail sales data that came out today, much weaker than expected. If you look at the bad earnings yesterday or 2 days ago from Macy's, yesterday from Nordstrom's, it seems like people aren't really getting jobs because they're not going out there and shopping. They're not spending money like they have jobs. So, and who knows how they're going to revise these numbers next month. They could revise the numbers down quite a bit, and then the number could end up being weaker than we first expected. I mean, that's the part about these jobs numbers. But look, we've had a bubble the entire time. The Fed has not created legitimate economic growth. This is a gigantic bubble, and it's the bubble that can't withstand higher interest rates. If the Fed raises interest rates, this bubble is going to be pricked, and we're going to have a worse financial crisis in 2008. In fact, without the quantitative easing, the air is already coming out of the bubble. That's why the stock market's not making any headway. That's why the bubble the economy is starting to deflate. And I think the Fed's going to do QE4 next year. I mean, we're all talking about rate hikes. The real thing they're going to do is another round of quantitative easing.
So what do you think that the actual unemployment rate is? I mean, they're giving us this number of 5.1, right around 5%. I mean, you're talking about, structural unemployment. What about people that are that just have given up? What do you think the actual?
Yeah.
What do you think the actual?
Well, we know the government does report another unemployment rate, the U6 rate, which includes people who are disgruntled and want to work but have given up looking, and it includes people who are still looking for full-time work, but they've taken part-time jobs in the interim. And that rate is around 10%. So I think the real rate is somewhere between 10 and 20%. The government is just not measuring it properly. Look, we've now got the highest percentage of young men and women, that's ages 18 to 34, living at home with their parents since the 1940s. Why are these kids living with their parents? One reason is because they can't get jobs. That's why they're still living at home. Of course, another reason is even if they get a job, the pay is too low to afford to live by themselves, especially if they made the mistake of going to college and borrowing a bunch of money. And so they have to deal with their student loans. But all the anecdotal evidence suggests that the economy is really in desperate situation, and that's why the Fed has got it on life support. I mean, ask yourself this. We've had 0% interest rates for the last 7 years, yet this is the weakest recovery in history. Imagine how much weaker the recovery would be if we didn't have 0% interest rates.
Yeah, great point. Okay, so you're not looking for like a very Merry Christmas here, and you expect, job layoffs to pick up by year end. And I mean, if I had to throw a dart, I would say the retail sector better start doing something. Where do you think these job layoffs are going to come from?
Yeah, I said that on a CNBC interview, and when I talked about the fact that it was going to be a bad Christmas, I wasn't talking about for families, right? I mean, families can still have a joyous holiday. You don't have to go out and give a bunch of gifts, right? You don't have to go out and buy a bunch of things you can't afford and borrow the money to do it. When I said it was going to be a horrible Christmas, I was talking about retailers. Specifically, I said it's the retailers. They're not going to have the Christmas selling season that they expect, especially if you look at the level of inventories. Our retailers have really stockpiled the merchandise on the false expectation that they're going to be able to sell it. They're not going to be able to. And we're getting the inventory data that confirms this. The most recent round of retail sales and earnings of the retailers confirms it. And so where I see the layoffs coming first, and I said they may start towards the very end of this year, or some companies might not want to lay people off. It's hard to give somebody, a pink slip in their Christmas stocking, right? You don't want to lay somebody off in the holiday season. But in early January, I would imagine we'll see a big pickup in layoffs. A lot of the jobs that were created in retail are going to go away. And that's, unfortunately, a lot of the job creation has been in the service sector, in retail, retail sales and places like that. And I also think, it's not just in the stores. I think in the restaurants and bars, people are just going to be spending less money. And, we've been creating a lot of waiter jobs, a lot of bartender jobs. So a lot of these jobs, these low-paying jobs, are going to go away. And, I think that the employment is the lagging indicator. The Fed keeps saying, we're looking at the employment rate to decide whether or not we should raise rates, the labor market. The labor market is, the last straw, right? It's not a leading indicator. Right. All the other leading indicators are flashing recession, and so what happens as the recession begins, that's when the layoffs start. It's the layoffs don't produce the recession. The layoffs generally result from the recession, and so the Fed is making a mistake, thinking that we should be guided by the labor market. What the official unemployment rate is. Look, the unemployment rate usually is at its lowest point just before a recession begins. And then when it begins, then the layoffs pick up.
Because I sure wish I would have heard that interview when you were talking about the retail stocks, because, oh, my gosh, there's just Macy's basically cut in half. Other stocks, I mean, just go on.
Yeah, Macy's is down, over 40% in 2 months. But Nordstrom's is going to open down 20% from where it closed yesterday.
Yeah, not a good sign. All right, so
it's on the open.
After the retail sector here, what else? Where else are they? I mean, if it comes from retail, it's going to spur other things on. What other sectors do you expect to see layoffs coming in?
Well, I think we're going to see layoffs in the auto sector. Americans have gone on a buying binge with automobiles, with cheap financing. And of course, I think one of the reasons that a lot of young men are buying cars is because they live with their parents, and that's really the only thing they have to spend money on other than clothing, is they'll go out and buy a new car, so that when they go out, to a bar, at least they look like they're somebody because they have they have a car. Plus, if you live with your parents, you can't take the girls back home, so maybe that's where they have all their sex is in their car, so they have to buy a nice car. But I think that this is over. This is a bubble that's going to burst. Also, I think the home builders. I think construction is going to see a lot of layoffs. I think we have had a big spurt of construction, especially in multifamily. But with so many young people living with their parents, who's going to rent these 1 and 2 bedroom apartments? I don't know. We're just So I think we're going to have jobs in construction, layoffs in construction, layoffs in autos. Ultimately, in finance, this bull market bursts in the stock market, and a lot of these loans, a lot of people who borrowed money to buy stuff, if these loans go into default, we could see some declines there. Look, there was a company, what was it? Not Loans R Us, or what's the name of that company that they just canceled their IPO?
I can't think of the name of it either.
Yeah, it's like Loan Depot, Loan Depot. But there's all these lenders out there that this finance economy has been booming. The reason that people are borrowing so much money is because they don't have any real income. They have lousy jobs, and they're trying to survive by borrowing money. And so there's been a lot of profit in lending money, but eventually, if the people who you loan money to default and they can't pay you back, then those profits turn into huge losses. And so the lending business ends up being a disaster. And we saw that in the financial crisis, right? It's easy to make a loan when you don't care about getting paid back. But when it becomes obvious that the loans that you made are not going to be repaid, that's when you have the problems. So the financial sector can see a lot of layoffs. I mean, we could be on the cusp of a tsunami of layoffs.
All right, so you're alluding to debt here, and the IMF came out with their global financial stability outlook, and you're touching on some things here. We have emerging markets, vulnerability, legacy issues from the crisis in advanced economies, and weak systematic market liquidity. We got all this debt up there. Two questions here: if interest rates going up, are they going to have to pay higher service on their debt? I mean, what are we going to do with all this debt out there? Are we just someday just we'll just?
Oh yeah, I mean, if interest rates really did go up, right? Then yeah, the debt service costs would go up, and that's one of the reasons that I've believed all along that the Fed was just bluffing about raising rates, because they don't really want to impose that cost on American debtors. Certainly including the federal government, which has a tremendous amount of debt. And so if the Fed were to raise rates, I mean, that would just make things harder. I mean, it would prick the auto bubble quicker. It would prick the housing bubble. Imagine what's going to happen. Think about all these Americans that still have adjustable rate mortgages. And the main reason that anybody has an adjustable rate mortgage now is because they can't even afford the fixed rate. They're so over their head that the only way they can make their mortgage payments is having an adjustable rate. And they're probably just barely getting by living paycheck to paycheck now. So if all of a sudden rates go up a little bit and their mortgage payment is an extra $100 or $200 a month, where are they going to get that money? I mean, it may not sound like much, but if you're just barely getting by, if your checkbook is barely balancing, and all of a sudden, you need $200 more per month, where are you going to get it? So this is going to be a problem.
Right, and also, what about all the companies out there that are borrowing money to buy back their own stock at all high?
Oh yeah, I mean, look, I mentioned, look at all the stock that Nordstrom's bought back last year. Oh. And now all that stock is just take a 20% haircut. And at the same time they announced these bad earnings, they announced a bigger stock buyback. I mean, this is what's been going on. All these companies have been buying back. I mean, the poster boy has been IBM. And look, IBM is at a multi-year low. IBM is the lowest it's been since 2010. Think about all the stock they bought back in 2012, 2013, 2014 at over $200 a share. The stock is 132. How much did they blow? And what didn't they do with the money that they wasted on share buybacks? They didn't invest in R&D. They didn't invest in plant and equipment. All these companies are wasting their profits on share buybacks. So when the stock collapses, they have nothing to show for it. Meanwhile, they're going to lose ground to their competitors because they didn't do the investment that they should have been doing because they were trying to prop up their stock price.
Yeah, exactly. Look at the chart on this one. I wonder if Mr. Buffett's having any second thoughts on this one. Moving on here, we're getting a question out of the chat here. The metals have just been getting pounded lately here. Gold under 1,100 had a little pop. It looked like we were gonna, get close to, that $1,200 level. Now we pulled back just over multi-year lows here at the 1040 level. A lot of people looking for triple digits in the gold market. What's your take on gold?
Well, again, everybody's got the Fed wrong. When people thought the Fed wasn't going to raise rates this year, in mid-October, gold was knocking on the door at 1,200, and now that everybody thinks they're about to raise rates again, it's back below 1,100. We've had over a $100 drop just based on the changing expectations of whether or not the Fed is going to raise rates in December. But, it's a long time between now and December. The Dow is already down 450 points this week. If it keeps falling, the Dow rose about 2,000 points on the idea that the Fed wouldn't raise rates in 2015. Now that everybody believes that they will, the Dow should surrender that 2,000-point rally. In fact, maybe it'll make new lows. And that's another reason that I don't think the Fed is going to raise rates, because the Fed wants to support the stock market. That's been their modus operandi. It's try to keep the market up. Well, they can't do that if they're raising rates. They can only do that if they're not raising rates or maybe doing another round of quantitative easing. So I do believe that the economic data will continue to come in weak, that the November jobs number that we get early December will be much weaker than the jobs number we got for October, and in fact, they may revise significantly lower the October number. And based on weakness in the stock market and the economy, there's a good chance that we don't get the rate hike in December that everybody thinks we're going to get, and the price of gold takes off. But even if they do raise rates, they have been anticipating a rate hike in the gold market for years. This is going to be the most highly anticipated rate hike in history. And we all know as a trader, it's buy the rumor, sell the fact. So by the time the Fed actually gets around to doing something that the markets have been anticipating for years, it's much more likely that gold is going to go up on that event than go down. And of course, I think that the gold market is factoring in much higher, much bigger rate hikes than what we're actually going to get if we get any rate hikes at all. And of course, if there is no fact, if it's just false rumors that never come true, then gold can rally in an even more spectacular way. But also the idea that higher interest rates are automatically negative for gold, that's not true. Look, when the Fed raised rates last time, which was over 10 years ago, or 12, 13 years ago, when the Fed started their last tightening cycle, gold rose the entire time. It was a huge rally in gold. As the Fed was tightening, gold was rising. So to say that, well, if the Fed raised rates, it automatically means gold's going to go down. No, it doesn't.
So what should the investor do? What should the typical investor do at this time? I mean, just at the beginning of last week, we were within a percentage point of all-time highs. I mean, what should investors do with their money?
Well, they should buy gold.
Okay.
They should buy gold stocks, which are amazing bargains right now if you look at gold stocks. But yeah, I have a precious metals company, Schiff Gold. People can buy physical gold and silver. And at my brokerage firm at Euro Pacific Capital, we're helping clients identify the right gold stocks to buy. I manage a gold fund for people that want to get a good diversified investment. The Euro Pacific Gold Fund. And we're investing abroad. The overseas markets are really on sale because the dollar's been so strong, particularly the emerging markets. Stocks have been crushed in dollar terms, 30, 40, 50%. There's some great bargains there. Everybody just assumes that the dollar can only go up because everybody believes the Fed is going to raise rates, and everybody believes that that's bullish for the dollar. Well, everybody believes it. It's already factored into the dollar. So either the Fed raises rates and we get, buy the rumor, sell the fact, or they never raise rates and there is no fact. But either way, you've got some incredible deals. Every expert I see, they're universal in their opinion. The dollar's going to go up, and they're wrong. Whenever you get everybody thinking something, they're usually wrong. And this is a situation where there's almost 100% agreement on this thesis. Pretty much the only person that doesn't agree with it is me.
Okay, all right. We've been on the line with Peter Schiff of Euro Pacific Capital, Chief Global Strategist, giving us your take on the market. And, boy, I'll be looking forward to that December jobs report, Peter. Thanks for coming on. We hope to have you on again soon.
Sure thing.
Thank you.